We'll keep going.
Before you hit record, Faith and Marilyn, you know, this is recorded, so then it gets posted on the group and then everybody sees it too. So even your slide.
Okay, hi everybody. Welcome back. We are here with another wonderful expert, Marilyn, is it Campion? Campion, okay. She is a specialist in retirement benefits. She's a retirement benefit consultant. So she helps you figure out things like your 401k plan, what type of retirement benefit plan you might do for your employees. And but I am going to push her to talk more about solo plans as well for people who are solo business owners and are looking at doing something like this to help with taxes and other things like that. So she's prepared a presentation for us. I'm going to let her go through it. And we are so grateful to her and to beautiful Claudia as well coming on and helping us to understand some of these things that are a little tough to understand, a little tough to figure out, but can have a great benefit down the road if we can learn how to do it correctly. So I'm going to let her take it away. Would you like to share your screen and go through the slides, or do you want me to? I can scroll through your slides and share the screen on my end.
Whichever's easiest for you.
Okay. That's probably, yeah, it's probably easiest if I can just do it, actually.
Okay, perfect.
Okay, so I'm going to share screen. There we go. All right, cool. So everybody, if you guys have any questions, feel free to either put it in the chat box or you can unmute yourself and just come on and ask. That's also perfectly fine. And I'm very interested. We've got a few people on here who I know do have questions, so I'm excited to hear what they are.
Excellent.
All right, take it away.
Okay. Well, thanks everybody for letting me talk and present. I'm kind of geeky that way, I guess. I love talking about 401k or retirement plans. I've been doing this for over 30 years, so I guess technically I'm an expert in the field. I started out doing more defined benefit plan administration. Then when defined benefit plans kind of went out of the way and 401k vehicles became the more popular vehicle for preparing for retirement, I kind of went over into that field. With that being said, now what I'm doing is more the business development, and I do that through plan consulting. I really love to talk about what we're going to talk about today, sit down and become very specific with each employer's needs, because there's a lot that we're going to talk about today that you're going to find probably overwhelming. But again, please remember, this is even at a very high level. And your consultant should really talk to you on a more specific level about the types of plans, what it is that you're looking for and want. So with that, let's hop into talking about plans.
Okay, oops, sorry. So
no worries.
Can you see it properly?
I can.
Okay.
Do I have control or do you have control?
I've got control.
Okay.
You just have to tell me if you want me to advance it or.
So go ahead and go down to probably slide 3. Just go ahead and go through the slides.
Okay. So you want me to go back or forward?
No, go forward.
Which one do you want?
Can you go to slide? Let's go to slide 3.
That was 3.
It looks like the screen may be frozen.
Oh, maybe it's frozen? Hold on.
There we go. Perfect.
Okay, so it should be, let me stop share. Let me try to do this again. Hold on. Okay, now can we see it?
Yep, perfect. So what we're going to do is I want to talk about really the difference between defined contribution and defined benefit plans. So these are two types of retirement vehicles, but they're very different in how they operate. So in a defined contribution plan, you're going to define the contribution that goes into the plan every year. So for example, you may make a profit sharing contribution of $50,000, and then the plan will dictate how we're going to allocate those contributions, but you're defining that you're putting in $50,000. You as an individual may say, I'm going to do $19,500 as 401k deferrals. Again, defining the amount that you're going to put in each year. In the defined benefit plan, we're going to define the benefit that you will have at retirement, and we will also define the benefit every step of the way. So I can tell you today what your benefit is in the defined benefit plan. I can tell you what it is in 5 years, 10 years, and even what it will be at normal retirement age.
So do you mind if I kind of pop in and out?
No, please do.
So it would seem to me that from what I've been listening and stuff, nowadays we don't really use defined benefit plans as much as contribution plans. Is that what might be the reasons for that? Like why might somebody choose one over the other?
So defined benefit plans, we see a lot of smaller employers using, because we can use techniques, which I'll talk about later, that will really give some leverage contributions towards the owners of the company. The problem with defined benefits, or the pitfall, is that defined benefit plans lock you into a funding requirement, and you have to have the assets available to meet the liabilities of the plan. Where in the defined contribution plan, you have tremendous amounts of flexibility. In the defined contribution, much smaller annual accruals and limits that you can put in the plan, compared to a defined benefit plan. Depending on the age, you can contribute up to $200,000 a year for an individual. So there's pros and cons of both.
So for the benefit plan, you can put in more, but you would need to really make sure you have those assets, a lot of assets available. Whereas for the contribution plan, there's more flexibility. So if you have a good year, bad year, you could change that up a bit more.
Exactly. Exactly.
So because entrepreneurs are what they are, you know.
Exactly. And trust me, there's a lot of consulting that goes into and making sure people understand what they're committing to in a defined benefit plan. And the other thing, trust me, I've worked with Claudia on these types of plans. The advisor, it's really important that the advisor understands what we're trying to achieve, because investing in a defined benefit plan, you need to have the right sort of portfolio to make sure that we're not having a lot of risk on the table with these. And I'll talk a little bit about that.
So the issue with the defined benefit plan is that you're defining what you're going to have at the end of that retirement. So what that means is that if somebody, let's say you have $100,000 in there in a variety of stocks and bond assets, but the value of that drops, the value of those stocks drops significantly, then you have to put more money into the plan to get back to that same amount of benefit.
Exactly.
So that's the issue, and that's what happened to a lot of large companies where their pension plans and other things like that, I don't know, what would you call it? They failed, or they actually bankrupted the company.
Exactly. And you'll see in some of those situations, there's issues where Pension Benefit Guaranty Corporation has to take over. But as a last resort, the plan may not be funded, but there is a funding obligation, and you have to meet those funding requirements to keep that plan funded, or there's penalties for that. So there's a lot of risk with a defined benefit plan.
So for instance, if you were to have a lot of assets, like let's say you had a lot of money and you want to tuck that into there, maybe you're getting older and you're close to retirement or something, that might be a good option for you potentially, because then you can put more money aside into that.
Correct.
Than if, say, a young new entrepreneur. That might be.
But you can't pre-fund those. You have to fund them annually. And the reason you can't pre-fund them, I mean, you can slightly, but you can't for the most part is, again, there's deduction limitations. And the IRS doesn't want you taking a larger deduction than you're entitled to. So they won't let you pre-fund it. Great questions.
All right, thank you.
So very quickly, let's go back one more. I just want to hit again. On the defined contribution plan, I can't tell you what your benefit will be at retirement. And the reason I can't is it depends on the contributions that you choose to fund each year. And then it's based on asset performance. So if the assets go up, so will your benefit at retirement. If they go down, your benefit at retirement will go down. So I have no idea what your benefit is at retirement. In a defined benefit plan, though, like I said, you have that guaranteed benefit. So if the assets aren't performing correctly or at the assumed funding level, then you have to fund more. Or if the assets are outperforming the assumption, which is usually 5%, then you would fund less. So it's really important, again, that we understand that defined contribution will be, your benefit at retirement will be dependent on asset performance, and defined benefit plan is very independent from asset performance because you have to make additional contributions. Okay, next slide.
All right.
So now I want to talk about defined contribution plans. And one of the things that Kaylee said is that, you know, their first retirement plan was a SEP or a simplified employee pension plan. So that's a really good place for small employers to start out if it's going to meet their needs. And by that happening, it's very easy for a participant to get into the plan. So we can't restrict, or it's very easy for a participant to be eligible. And the way that a participant becomes eligible for this is if they're age 21 and they have worked at least 3 out of the last 5 years for the employer. There's no minimum hours requirement. They're eligible for the SEP plan. So if the employer decides to make a contribution, then they have to make it for those individuals who have met that eligibility requirement. There's no mandated contribution, but they have to give it to the employee. There are only employer contributions in these type of plans. There's no employee contributions. And usually the contribution is on a pro rata allocation. So let's say we do $50,000 contribution, everybody gets an equal part of that based on their compensation to the overall compensation.
So it's done, their allocation of that $50,000 contribution is based on their salary range.
Correct. So everybody would probably get like,
and one person's being paid 50,000, then that person with 100,000 is getting double of that contribution.
Correct. So it's very similar to just saying we're going to give everybody 5% of pay, and that equals $50,000. But we can back into that so that we know the percentage everybody gets.
So why might you pick this one?
Pardon?
Why might an employer pick this one?
Just because it's very simple to participate in. It's an IRA type of plan. And with it being an IRA or an individual retirement type of plan, there's no trust. So there's no administrative costs. There's no Form 5500. There's no fiduciary liability. It is very simple, and it's only employer money that's going into the plan.
Got it.
Okay. The contributions are 100% vested, so you can't say that, you know, if somebody terminates, they're not going to get their full benefit. They will get their full benefit. And because it's in an IRA, those benefits can be distributed at any time. The plan sponsor has no control over those investments because, again, they're individual accounts. Okay, any questions on that?
So Keely has a question. She says, if I recall, every employer has to open an IRA and the employee takes it with them.
Yeah, when we did this, and it's been years, we had to request, and we actually had to put in the agreements, employment agreements, that employees, in order to receive it, had to open up their own separate IRAs for the money to be deposited. And that becomes tricky because if they don't work, you know, if they've met the threshold to participate, but they don't open the IRA in a SEP, you can get in trouble as an employer if you don't have anywhere to make the contribution.
Correct. Sometimes you can set up an IRA for the individual for that, but you're correct. A lot of times it can be difficult because you're dragging your feet with the employee setting up that IRA. But there are custodians that will let you set up. And ideally, it doesn't always happen, but ideally you'll have one custodian for all of the IRA so you can send the money all to one place. So the other type of plan, which is another IRA type plan, is what we call a savings incentive match plan for employees, or a simple. And this is, again, another IRA product. I'm going to be honest with you, we don't do anything with IRA plans. All of ours are qualified plans with trust. So this is just basic information on those. To be eligible for the, and I'm going to go into more detail also, I should say, because there's a simple IRA and a simple 401k. So I'll talk about what the differences in those are. But simples in general, you cannot have one, or they're not available to you if you have more than 100 employees. And 100 employees, you look at the prior year's employees, and anyone who made more than $5,000 is counted as an individual towards that 100 employees. Once you pass that threshold, you can no longer make contributions to that plan. This plan allows for employee deferrals. However, the limits for what the employee can contribute are much lower than what they are in a typical 401k plan. So the amount that an employee can defer into this type of a plan is $13,500 with a catch-up contribution of $3,000. If you compare that to a 401k plan, that's $19,500 and $6,500. So that's quite a bit of difference in those and what you can do. There is a required employer contribution, and I'll talk about that on the next slide. There is no discrimination testing. So everything we do has to prove that we're not having these plans in place to benefit the highly compensated individuals. So we either have to run a non-discrimination test, or we have to make mandated contributions. Another one of those requirements is that the contributions made by the employer are 100% vested also. These types of plans, there's no top-heavy minimum requirement, and I'll talk about what that means later on. These plans also must be on a calendar year. So when I say a calendar year, it's not uncommon for an employer to want to have their plan year coincide with their fiscal year. So if it's a June 30th fiscal year, especially when they're doing tax planning, they want to have that profit sharing contribution coincide with June 30th. In a simple, that's not possible. It has to be a calendar year. And so what's the difference, or why would somebody want, I guess, really want to participate in a SEP or a simple? Basically, if you want to participate in a SEP, you don't want to have the administrative burden of having to submit employee contributions every single payroll period, or versus in the simple, you're allowing for employee contributions and you're submitting these contributions every single payroll period, because the Department of Labor requires that the employee monies be deposited into the IRA or the trust as soon as administratively feasible, which is usually within 7 business days. Okay. Next slide. Okay, so now let's talk about the difference between the simple IRA and the simple 401k. And I really want to stress that I'm talking specifically about a simple 401k because there's different requirements for a regular 401k other than the simple 401k.
So what you're talking about is the simple plan you just talked about before. And under
Correct.
Correct. Simple plan here, the savings incentive match plan.
Correct.
Under that plan, you can either have an IRA or a 401k. Is that
correct? And the difference mainly between, I mean, I'm going to go through what the differences are, but the big difference is in the IRA, there's no trust. Those are all individual accounts. And in the simple 401k, there is a trust that's required. Okay. So in the IRA, to be eligible for the IRA, it's anybody who has made more than $5,000 in the prior year, and they're expected to earn $5,000 in the current year. So that opens it up to a very wide population of employees. I can't exclude because of hours or service or anything. If you've made $5,000 in 2 prior years, and I think you are this year, you're in that simple IRA. Compare that to the 401k. I can have an age 21 requirement and a year of service, and in that year of service required that somebody work 1,000 hours. So those individuals who are making $5,000 are never going to enter this 401k plan because they have to work 1,000 hours to be eligible for the plan.
So why that's important is because you may not want to have everybody you employ in the plan, because you have some people that come in and out, or maybe they're only working part-time. You know, there's all kinds of reasons why you might not want to have to set up accounts for a bunch of different people that are not maybe full-time or long-term employees.
Correct. That, so there's the administrative burden, but then there's also the employer contribution too. So if you don't have to make the contributions for the employees, a lot of employers say, I don't want to incur those costs either. Okay, and so let's talk about the matching contributions. If you have a simple IRA or a simple 401k, it mandates an employer contribution. And that contribution is either a match or a profit sharing plan or profit sharing contribution. So let's first talk about the difference between a match and a profit sharing. A matching contribution is only made if the employee makes a deferral. So if I don't make a deferral, I don't get a match. If the employer is going to make a profit sharing contribution, I don't have to make a deferral to get that profit sharing contribution.
So what are you saying? What do you mean when you say make a deferral?
So if I choose to put money or take money from my paycheck and not receive it as compensation, but to put it into the trust and defer it until retirement age, that's an employee deferral.
And if I do that as an employee, then I'm not taxed on that amount of money now, right? I would be taxed on that.
So you will defer that until you pull the money out at some later point in time. The exception to that is there is also a Roth component, and Roth are post-tax dollars, and then you don't pay taxes on those if you meet certain requirements and leave the money in there until retirement. You don't pay taxes on the growth in those.
Right. Yeah. So that's a very interesting structure. And what I'd like to do is kind of, so let's say you're a solo employee. Would you bother with like the simple thing, or just open your solo 401k or a solo IRA?
You know what? It really depends on what you're looking for. So if you have a simple, that's the only plan you can have of the employer. So you can't have a defined benefit plan along with that. And why I say that is because it's not uncommon for some of our solo employers to have a profit sharing 401k plan and layer that with a defined benefit plan, so they can get a much larger deduction, and they have flexibility because some years they always have to fund the defined benefit plan, but then in years where it's leaner, they don't have to fund the defined contribution plan.
So
and I've got illustrations for that.
Okay.
Okay. So let's talk about the match on those deferrals. So under the IRA provision, you're required to match 100% of the first 3% that somebody defers. However, 2 out of 5 years, you can choose to drop that 3% to 1%. So let's just look at the 3%. Let's say that I'm deferring 10% of my pay into the plan. The employer is required to match that and do 3% of my pay into the plan. If I choose to do 1%, the employer is going to do 1%. If I choose not to participate, the employer is not going to make a match at all. On the profit sharing, and it's one or the other, it's not both, on the profit sharing component, regardless if I make a deferral or not, the employer is required to do 2% of my pay as an employer contribution. So let's just take a minute and let's compare that. That's the IRA, compare that to the 401k, because they really are exactly the same. The only difference is under the 401k, the employer doesn't have the option to do that 1% for 2 years. They are always required to do a 3% or 100% of the first 3%. In retirement plans, we are only allowed to usually look at compensation up to a maximum dollar limit. And for 2020, that dollar limit is $285,000. So if somebody makes $400,000, when I'm talking about calculating that profit sharing contribution, I can only look at $285,000. That's the case for both the IRA and the 401k. But there's this really strange rule, and I'm sure it has to do with the fact that we're only matching 3% on the, we're only matching 3% on the deferrals. There's no compensation limit. So I can recognize that full $400,000 in coming up with the matching contribution. So I look at 400,000 for match. I only look at 285,000 for profit sharing. On the 401k side of things, I can only look at 285,000 for both determining the match and the profit sharing. There are minimum required distributions applied to both of these plans. The minimum required distributions under the IRA fall under the IRA rules, and the minimum distributions under the 401k plan falls under 401k plans. And there is a difference, and I'll talk about that on a different slide, but it is subject to minimum required distributions.
So it's my understanding that if you wanted to make a tax deferred contribution to some of these, to a 401k or some of these accounts, is there a limit where, is there like a compensation limit? So for instance, if I'm making over a certain amount, I can't contribute, or is that limit only, I can't contribute tax deferred, or is that only for contributing tax into the Roth?
So there is limits on how much can be contributed, and I've got that on an additional slide, and it'll talk about how much you as an individual can contribute to the plan and how much the employer and you combined can put into the plan as an overall limit. And if you exceed those have to be returned, or else they're non-deductible, and then you pay excise tax for non-deductible contributions.
What I meant actually was, if I want to make so if I'm like looking to decrease my tax bill, right? So I'm gonna contribute the 19,000 into this 401k plan.
Yes.
To bring my total, like my total adjusted gross income down.
Correct.
So if I'm making over a certain amount of income, then am I not allowed to contribute that tax deferred, or is that still okay?
No, because these are retirement vehicles and they're not IRA contributions, those limits don't apply.
Ah, okay.
So, and that's a good question too, because on the Roth component, keep in mind Roth IRAs have different rules, and they have an adjusted gross income that limits and doesn't allow you to make Roth contributions. That limit does not apply to 401k plans. We don't have to look at people's adjusted gross income.
So it doesn't apply to any like traditional plans, it only applies to the Roth plan. Adjusted gross income limit?
As far as deductions and contributions, that's correct. And then, you know, for the IRA, it's like 6,500. I'm not even sure, Claudia, do you know what the maximum IRA contribution is for 2020?
I think you're right on with the 65.
Okay, so there really is no compensation limit per se, but there are deduction type limits that apply that, again, IRAs I'm not familiar with, but these are IRA vehicles, retirement vehicles that are just held in IRAs. So those do not apply here.
Okay.
Okay.
So, all right, let's keep going.
Okay. One other thing on there, go back to one slide, I'm sorry. There, in the IRA, because it's an individual retirement account and there are no administrative policies in place and nobody's overseeing this, loans are not permitted because there's nobody to monitor that, to make sure loan payments are started, they're made, they're defaulted, anything. But you can have loans in a 401k, a simple 401k. Again, there's no trust for the IRA because they are IRAs. Because there's no trust, there's no Form 5500, which is the government reporting form. On the 401k, there is a required trust and there is government reporting that's required annually. Okay.
Okay, so just to make that clear for people, an IRA or an IRA is basically what, like a bank account?
Yeah, I would say so. It's a brokerage account and you take ownership of it. So you own that. Versus in the 401k plan, it's a trust and you're entitled to that benefit. You have kind of ownership in it, but it's not yours until you take ownership of it and you pay taxes on those dollars. So until the money's distributed, it's part of that trust and it's not yours. And the thing that's really important about that is that these trusts are very much protected from creditors, employers, everything. This is set up in the name of the trust. Lots of protection.
Yeah, so that's very important to know about 401k for protection.
Yes.
Because it's a trust, so it's a different vehicle, kind of like a company, like an LLC or something like that. It's owned by that trust, not just owned as an account for you directly.
Correct. Versus the IRA, that is dependent on the state. So some states, IRAs are subject to creditors, but some states they're not. So that falls back on the state. So just really quickly, when we talk about defined contribution plans, there are many, many types of defined contribution plans. There's profit sharing plans. We talked about 401k. You'll hear the term 403b for nonprofit entities. That really is very similar, not the same, but very similar to a 401k plan for a nonprofit entity. We have 457b governmental plans that are very similar to a 401k plan also. I want to point out here that we also have 457b non-governmental plans and 457f plans. Those types of plans are non-qualified plans, so they're more executive compensation type plans. But the only reason I'm pointing that out is because a lot of times people say, oh, you have a 457 plan, I know about that. And please be careful and wary of that comment, a 457 plan. A money purchase plan is really the same as a profit sharing plan. There are minor differences besides the one that I'm going to talk about. But really on a money purchase plan, that is an old plan. We don't have many of those around anymore because it used to be profit sharing plans were limited to 15% of pay. They now have a 25% limit also. where money purchase plans did have that 25% deduction limit. But the downside to that is a money purchase plan has to have hard-coded in there what the contribution amount is annually. So you lose, again, that flexibility. It's not a discretionary contribution. So when that limitation or deduction limit increased on profit sharing plans, we don't see many money purchase plans. Most of them were converted to profit sharing plans. Then we have the employee stock ownership plan, which is basically a profit sharing plan that invests primarily in stocks, in employer stocks.
Mm-hmm. So also it would be nice to talk about is kind of when somebody might use one of these different plans. I'm guessing most of these are not really applicable to our audience necessarily.
Correct.
401k, probably. The other ones probably not so much.
Correct. Yeah, and I would say mainly the type we're talking about is the profit sharing with the 401k component. That's what we're going to be most familiar with. So let's talk about profit sharing 401k plans. These are, like I said earlier, subject to non-discrimination testing. So everything we do has to prove that the plans are put in place for the employees. We get a free pass on that if there are no employees, but otherwise we do have to show that we're not discriminating in favor of the owners. There are minimum age.
So how do we show that? What does that mean actually?
I'm going to show that on another slide, and we'll show how we have to pass those non-discrimination tests. Okay, great question though.
For instance, if somebody wants to say, okay, I want to have a plan, but I want to be able to stock aside a lot more for myself than I'm doing for my employees. That's
correct. And where it really becomes important also is in the deferrals. So let's say that the owner's deferring the $19,500, but you have no employees making deferrals. Unless we have a safe harbor provision, all of those deferrals have to be returned to the employees. So it's really important that we pay attention to what's the best plan design for the owner or the plan or the employer. And what are we trying to achieve?
If the employees don't make contributions, then the employer's contribution is returned back?
If the employees don't make 401k contributions, then contributions that the owners would have made as 401k deferrals, those have to be returned to the owners. I'm going to show you how we get around that with safe harbor, but that's some of the non-discrimination issues that we have to deal with. Okay. We have that minimum age and service requirement, that required minimum distribution. This is where it's different. Required minimum distributions in a qualified plan are only required for 5% or more owners if they are actively employed. If you are actively employed and not more than a 5% owner, you do not have to take a minimum distribution. But as soon as that employee terminates, they're required to take those minimum distributions. So it's not uncommon for somebody who's older and they're still employed, if they have an IRA, they possibly want to put it back into a plan like this, because in the IRA, they have to take the minimum distribution, but from this plan, they don't have to take the minimum distribution, so they can continue that tax deferred status on those dollars.
So this is really, we're only talking about people who are over 72.
Correct.
That's what the minimum distribution applies to. It doesn't apply to anybody else.
Correct. Correct. Good point. And for 2020, minimum distributions are not required because of everything happening in the market. And it was with the COVID in the CARES Act, it eliminated those for 2020. I talked about this earlier, the contribution, or you had asked about it, Faith, is what's the maximum amounts that can go into the plan. As an employee, I can contribute $19,500 of my personal pay. Overall, so between profit sharing, matching contributions, 401k deferrals, the maximum amount that can be contributed to me is $57,000. If I am 50 or older, I am catch-up eligible, and I can defer another $6,500 into the plan. So there's advantages to being 50 or older.
So why might somebody, Like if you're an entrepreneur and you're looking at this, why would you want to do it, basically?
The biggest reason is the tax deferral, and the money in the plan grows tax deferred. But the biggest reason employers do this usually is because they want that tax deduction. So this comes off as a deduction on the corporate tax return, reducing the tax liability.
So that's because the employee is getting, they're putting money in, so potentially their tax is going to go down. And then the employer is putting money in, and which that makes their taxes go down.
Correct.
Right. Okay.
Yep.
So if you don't have so basically if you wanted, it's useful for decreasing your taxes and then putting it into a separate vehicle where you can still monitor it and grow it.
Somebody had a question. I'm sorry, I didn't see that. There was a question on the IRA. I'm sorry, the minimum required distribution.
Yeah, so somebody says, somebody's asking if you can restate something. They said the IRA has a RMD, minimum required distribution, and the 401k doesn't have one unless you're an owner. That's their question.
Correct. So the IRA has the minimum distribution requirement. And if you are less than a 5% owner, or I should say a 5% owner or less, there's no minimum required distribution in the 401k profit sharing plan.
So that means you have a lot of employees in that plan to push your ownership below 5%.
No. I'm talking about, so if I'm 100% owner of the company, then I'm subject to minimum required distributions when I turn 72. If I'm a 5% owner, because it's got to be more than a 5%. If I'm a 5% owner and I'm still actively employed, I do not have to have a minimum required distribution.
Ah, got it. Okay.
And then it says, do solo plans have RMDs? And usually a solo plan is just the owner participating, and they're more than a 5% owner, so they would have an RMD. But if they are just an employee and no ownership, they do not have an RMD required. And for 2020, nobody has RMDs required, not IRAs, and there's no retirement plan. Did I answer all those questions?
Yes, thank
Okay.
you.
Okay, perfect. Okay. Then there's a lot of times we like to say there's a discretionary contribution. So you're not required to make contributions to these plans. And where we have to run into problems, especially with smaller employers, what we try to do is set these plans up where we're able to pass the discrimination testing and leverage the benefits to the owners. So a lot of times these plans become what we call top heavy. Top heavy means we're going to look at all of the plan assets, not just the contributions, but all of the plan assets. And if 60% or more of those plan assets belong to key individuals, the plan is deemed to be top heavy. If the plan is top heavy, now we have a mandated employer contribution, and that contribution is usually 3% of pay. Because the rule is it's the lesser of 3% or the highest allocation that a key employee received. And by a key employee contribution, that also applies to 401k deferrals. So I'm an owner, I deferred 10%. Well, I've automatically now kicked in that minimum required distribution because my plan is top heavy. So we have to do a 3% contribution to all non-key employees. So we need to make sure that we understand there's a really good chance we're going to have a required 3% contribution for our employees. Okay. Vesting schedules apply to the employer contributions in this type of situation. And what the vesting schedule just says is if you don't have enough service, you don't have ownership and get the full employer contribution if you terminate. So and the most common vesting schedule is after 2 years of service, you get 20% of pay. I'm sorry, 20% of your account balance. And it goes up in increments of 20 every year until you're at 6 years, and then you're 100% vested. So let's assume that I terminate after 2 years of service. I am now entitled to 20% of my account balance that are profit sharing, and the other 80% that's in my account will now go back to the plan and be used to reduce employer contributions, profit sharing, or match, or it can be used to pay employer fees for the plan. So those are forfeitures. So that this is subject to, or you can have a vesting schedule. As I said earlier, this does require a trust. The trust can either be participant directed, the investments can be participant directed, or it can be trustee directed. I will tell you that 99% of our 401k plans are participant directed. So there's a fund lineup, and the participants can choose to invest their money in the funds that are available through the plan. And then every once in a while, you'll see trustee directed investments for profit sharing plans. If it's a trustee directed plan, those are usually valued annually, and participants only know what their account balance is annually. And a lot of times it's not until 6 to 9 months after the end of the plan year before they even know what their account balance was for the end of the prior plan year. Because this is in a trust, again, a Form 5500 is required, so that's that government reporting form.
Marilyn, can I chime in for a second here?
Absolutely.
I think the key thing, and Faith, also for the participants on the call and then everybody else that will be watching this, is just to know that, you know, deciding which plan is going to be best for your company is going to require a little bit of working with your advisory team. Sometimes I think we oversimplify, or we hear, oh yeah, everybody should have a SEP IRA, or everybody should have a solo 401k. And there's so many different plans out there and so many details to consider that it's really prudent to find out more about these plans. And now you have it recorded, you can go back to the details and really see what is your objective, what are you trying to accomplish by putting this plan in place. And so this is an overwhelming amount of details, but I think it just illustrates that you have a lot of options in the retirement plan universe. And at the end of the day, it's going to come down to what's the main objective for your company? Do you have employees? Do you not have employees? And sometimes 401ks are used to attract quality employees as well. So
correct.
Your question, Faith, right? It's, yeah, we look at tax benefits and incentives, but really if you want to keep loyal employees and if you want to attract really high caliber employees as your companies are growing, some of these plans, to have them or not have them, may be the decision factor of someone to join you or a different firm. So just keep that in mind as well, that yeah, it may cost you 3%, but it'll attract some better employees. So just know there's a ton to know, lots of details. We totally realize that, and they can be highly customized to your needs.
Exactly.
Oh, Marilyn, what if everybody would be considered a key employee? Let's say you've only got 3 employees.
So the key employee, so there's definitions, the statutes have definition for key employees, and there's a difference between key employees and highly compensated employees. I've got another slide that tells us the definition of highly compensated, but key employees is basically looks at ownership. It also looks at if you're an officer of the company, and it looks at compensation. So there's a slight difference, but it really is key employees who have powerful positions within the organization.
Right, but
influencers.
If there's only a few, then that 60% test doesn't work because they're all that and you're paying it to all of them. So, you know.
But you know what? If a lot of times, and I'm going to show you on another slide, it's not uncommon to be able to put away $50,000 for the owner and the employees only get $1,500, that's a top-heavy plan very quickly.
All right.
Okay. So the non-discrimination, here we go, talk about that. Anybody who is highly compensated, anybody who is more than a 5% owner, regardless of what your compensation is, you are automatically a highly compensated individual. There are attribution rules that apply for that. So if I own something, anything I own, my husband's considered owning, my children are considered owning, and my parents are considered owning. So those attribution rules apply. So if I own 50%, all of those individuals own 50% of the company. If you make more than $130,000 in 2019, you're highly compensated for 2020. So we always look at the prior year. And I should say that $285,000, the 401k deferrals, the catch-up, this compensation, these are all adjusted with cost of living adjustments each year. So these things are all published and changing every year. But as of 2020, this is what the rules are. Then we can invoke a top paid group election. So larger employers sometimes say, I'm going to only look at the top 20% of my employees, and if more than them make 130,000, the people who are less than 20%, they're not going to be highly compensated. Again, another creative plan design thing that we would discuss in more detail if we got to that situation. We'll go back one quickly. Minimum participation, we have to cover at least 70% of the employees and allow them to participate in the plan, or at least 70%, I should say, of the non-highly compensated. Then we talked about that discrimination test and how much owners can put into the plan. We have to pass what we call the average deferral percentage and the average contribution percentage, and that all has to do with deferrals and match. So the highly compensated individuals can only do 2 percentage points over what the non-highly compensated, what the non-highly compensated do. So I like to have a real simple analysis of that. And let's assume we have 5 non-highly compensated employees. The first one is all excited about this. They defer 10%. The other 4 say, I'm not going to make any deferrals at all. So I add up 10 plus the 4 zeros, I get 10. I divide that by 5 and I get 2%. 2 percentage points over that plus that 2 is 4. So that means that my highly compensated employees can only defer 4% over the non-highlys. So I'm sorry, can only defer 4%.
This might be a little too much detail for our
okay.
So I think it's good that they know that this exists and this is something that they can talk to somebody about, but
right.
I don't think that they're going to be getting into this as much versus highly compensated versus not, et cetera, et cetera. The more just
great point.
Potentially in a plan. So
right. And where I want to go with that really is that, Faith, remember you had asked about the owner putting in the 19,500 and the employees putting in nothing. If the employees put in 0, that entire 19,500 has to be returned to the employees because we aren't passing this test.
Right. So in that case, if you don't think that the people who are going to be eligible for this plan, if you have a few employees, are going to put anything into it, then don't open it.
Correct. So that's exactly what happened. Is we saw in the early 2000s, employers were like, this is crazy. It's costing me for the administration. I've got my highly compensated who want to do this, but the plan, I can't do that. So that's when Congress enacted what we call safe harbor plans that gave us the free pass on these. And that's what we talk about on the next slide, is these safe harbor plans. I guess due to time, what I really want to say is that if you invoke some of these safe harbor provisions or invoke these safe harbor provisions, then you get a free pass on those and you are deemed to pass that non-discrimination test and no monies need to be returned. But it does mandate certain provisions. So you'll see that there's a 3% profit sharing or else there's a matching contribution. It's deemed to pass that top heavy minimum requirement we talked about, as long as there's no additional employer contributions. And then there is vesting depending on whether you use the safe harbor. The safe harbor is just immediately vested. And if you use this qualified automatic contribution arrangement, then it can be 2 years before those contributions are 100% vested.
All right. So let's, that's useful to know that this is here, and you can come back to it if this is an issue for you.
Exactly.
In that case, you probably want to get some counsel. So
exactly.
I more want to just focus on, like, what are we, like, if I want to set up one of these, what do I do? I'm sole owner in my business. You know, what could I put away before taxes?
So this is the perfect slide. So this is going to show you on the defined contribution, what is the maximum contributions you can do. And typically what we see is that they'll set up the profit sharing plan with the 401k feature. They'll contribute, the maximum would be $37,500 with a deferral of $19,500, which brings us to that overall limit of $57,000. Plus
so basically, sorry, just to explain to people what's happening here, is I can put in up to $19,000 from my salary paycheck, and then I can put in, so this really only works, I think, if you have a S corp, right?
Nope, we do it all the time for
payroll. You have to run payroll basically to be able to do these two. So you have to take part as payroll, and then you can take part as profit sharing, which
correct.
is the profit from the business that passes through to you as an owner.
Yeah, but we set these up for partnerships and sole proprietors also. So it just flows through on the earned income, the Schedule C or the K1.
Okay, so which part? So the deferral still has to be paid as a salary?
Nope. So the entire thing will run through and flow through based on your earned income, and for the profit sharing and the deferrals. So all of those, everything still flows through.
So if you just have an LLC and you're just doing Schedule C income, you can still use both of these.
Correct. And what happens is usually funded at year end or even after the year end. We're 401k deferrals. If it's coming out on a payroll, on a paycheck, then it has to be deposited immediately. But because it's a partnership or a sole proprietor, they don't have to be funded until after the end of the year when you're filing your taxes.
Right. So basically that means that you get to go through the year and you get to see how much money do I have left over and how is this going to affect my taxes, and then decide how much you're going to contribute at that time, which is very, very useful. That works only if you're doing this as like a sole owner of a business. You're the only person there, basically. If it's coming out of your paycheck, it has to be every month.
Exactly. And I should note that this is just kind of backing into what the profit sharing would be. If you said you didn't want to do any deferrals at all, you could do an entire profit sharing contribution of $57,000 to the individual. Again, that's some creative plan design and consulting that takes place, but the maximum as an individual would be the $57,000, and if you're catch-up eligible, an additional $6,500. And that $6,500 can only be 401k deferrals. That can't increase the profit sharing above the $57,000.
So basically, if you are making a couple $100,000 in income and you want to get yourself into a lower tax bracket, right? You don't want to have to pay tax right now on all of that $200,000, whatever that is.
Correct.
You can put up to $57,000 away into one of these plans. That will decrease your tax bracket as well.
Correct.
You'll have to pay a lower percentage of your total income, and you'll defer paying taxes on that $57,000 too. So that would be how we might use something like this.
Correct. So just to be clear though, that $57,000 is going to be an employer contribution. Now it could be, part of it could be the $19,500 that would reduce your personal taxes. But the employer, the $37,500 is going to be an employer contribution and deduction. So a lot of times a corporation will bonus out at year end that 37,000. So you're using that to reduce your compensation because you're taking it as a corporate deduction.
Ah, very good. Cool. Thank you.
Okay. Yes. So this is a really cool analysis that I wanted to show you. Again, it all depends on the demographics of your employees. So keep in mind that this doesn't always work, but hopefully it does. Let's assume the owner makes the 285,000. I have 2 employees making 35,000 and 30,000. My total compensation is $350,000. The maximum deductible contribution, so you can only have so much you can put away, is 25% of that covered compensation, which is $87,500. Okay, so when I look at that, I'm going to do a profit sharing contribution for the owner of $37,500. I'm going to do employee deferral, an employer contribution for the 4.39% for employee 1 and the same percent for employee 2, but you'll see that they're 15.35 and 13.15, which gives me a total employer contribution of $40,350. That is fine because it's less than that maximum deductible of the $87,500. Sometimes we have to be very careful about that because if the owner has low compensation, I can still probably contribute the $37,500, but it may reduce the maximum deductible amount. So we have to watch that. But look at on the right-hand side, you're seeing the different percentages we're able to give to the owner compared to their employees. Again, this is dependent on the employee demographics, with the owner being older than the employees. We get to do some age-weighted type calculations to pass our discrimination testing. But as you can see,
so can you maybe put this into like an example terms, I guess? So when you're saying I can take it as a deduction, it's basically the employer can take it as a deduction.
correct.
So as an employer, I can't say, oh, well, I want to put 50% of my, I want to basically deduct 50% of my profit by sticking it into here. The IRS still wants to get paid, so they're only going to let you deduct up to 25% of this total. So this is the compensation, as in compensation to all of the people in the entity, in the company.
Everybody who's receiving some sort of an allocation, that's exactly what it is. I look at everybody who's eligible for a contribution and I take 25% of that.
So that's the max that the employer can get a deduction for contributing.
Correct. Correct. But remember when you were talking about it's hard to get to that 60% threshold, this is the perfect example. When you're looking at this plan, would absolutely be top heavy, especially the owner can put in the $19,500 as deferrals and the employees might not put in anything. And that makes the plan very much top heavy because 60% or more of the assets belong to those key individuals.
Got it.
So that's really what I have for defined contribution plans. Then we talk about those defined benefit plans where you can get significantly larger dollars. So let's go to that next slide. Do we still have time? Are we doing okay? Or
we can do it. I mean, I think we just have to kind of move through it a little.
Okay.
Not look at all the numbers, just kind of explain what this is, and then people can look at it themselves.
Perfect. So in a defined contribution plan, we're going to define the contribution that goes in every single year. So typically when we set these up for an owner, we'll say a flat dollar amount that's going to go in, and then we'll say a percentage of pay for the employees. Then we have to run all kinds of actuarial calculations and make sure we're not discriminating. But the key takeaway here is you'll see that here we're contributing and saying we're going to contribute $20,000 in 2019. Okay, so I contribute $20,000 in 2019. At the very bottom, you'll see total. So my benefit at the end of 2019 is $20,000. The next year, I'm have an assumed interest rate of 5%. So now that $20,000 will move forward to $21,000. and I will have an additional 20,000 coming in for the current year. So at the end of the year, I've got a $41,000 contribution. And you can see that that keeps going across by 5%. I'm increasing it by 5% each year and adding another 20,000. So for example, at the end of 2023, this person's benefit due under the plan is $110,514. I told you every step of the way, I can show you what that your benefit is under the plan.
So this is a defined benefit plan.
This is the defined benefit. So we're defining the benefit.
Okay, so then the issue with this though is like, let's say you invest that money into the stock market and the stock drops. So in year 21, the value of those stocks that you're holding in the plan are no longer 63,000, they're 40,000. Then you got to add in another 20,000 to keep
exactly
63. So that's something just to be aware of with this type of plan. I think we can go to the next slide.
Yeah, and the next slide is the exact same thing. It's just showing it at 50,000. So depending on your age, we can actually start with these, and they can be as high as sometimes 150, 200,000. So just keep in mind that these amounts can grow substantially, and you really need to keep these plans around for 3 to 5 years. So where I show them sometimes going out for 10 years or 20 years, you just have to keep them around for 3 to 5 years, and then you can terminate it, enroll, and pay out the assets if you want to, or you can continue funding it. But keep in mind that, again, it is a required contribution. It's not a discretionary contribution, and we have to achieve that return on the investments.
Right, so let's say you've just sold your companies and you have a lot of money that you need to put into something, then that might be something where you get to do this a high contribution for 3 years.
I wouldn't say that, because if you sold the company, now you're not going to, that's more of a profit versus having some sort of earned income. So it has to be earned income, and you have to continue showing that you're going to have that earned income every year. Where we see this a lot of times is with doctors and attorneys, even people who say that they want to contribute more than that, you know, $57,000 a year. They may want to contribute $100,000 a year. So they'll put this type of a plan in, but they have to be able to know that that generated revenue is going to be there to fund those contributions every year.
And what happens if it's not?
Then what we're going to do is we're going to have a funding deficiency, and we have to know immediately so we can freeze these types of plans, because it is a required contribution. So one of the other things is, as long as it's not a professional service organization, which a professional service organizations like a doctor's group, attorney, again, accountant, those types of individuals are considered professional service organizations. Those are not covered by the Pension Benefit Guaranty Corporation. If you go to the next slide. Oh, I guess it's further down. There's what we call the Pension Benefit Guaranty Corporation, and they're like an insurance carrier on these defined benefit plans, and you're mandated to participate in this and pay annual premiums. If the plan becomes underfunded, it will require that you do additional funding for those. And in the event that there is no way other than bankruptcy that will cause you to not meet those funding obligations, then the Pension Benefit Guaranty Corporation will take over, and they will guarantee those benefits for the employees. And when I say they'll guarantee them, it's not necessarily at the level that they were promised, but they will kick in and provide benefits. But usually the owners don't get anything. In the professional type corporations, usually the smaller plans, as long as there's just one owner, they can waive their benefit to terminate and get out of this, but you can never have the employees waive benefits. So this can be a very dangerous territory in markets that can be very volatile, especially if you have an investment advisor who really doesn't know what they're doing and is overweighted in stocks. This really needs to be very conservative type portfolio.
All right.
Okay. So one of the other, so what we talk about now is if we add a defined benefit plan with a profit sharing 401k component, so we can do those and use the additional higher contribution levels for the owners, but still have flexibility on the profit sharing side of things to determine, especially this is a really great opportunity for those single employees where they don't have employees. So what we can do here is in that defined benefit plan, remember we have a set required contribution, and on the profit sharing component 401k is where we're going to get our flexibility. Go ahead and go to the next slide.
So, okay, so then this is with the defined, this is combining a defined benefit with a 401k.
Correct. So let's say, for example, that we have two individuals. Go ahead and go through this, just go through the slide there. And both of these individuals say that they want to contribute $150,000 to the plan, to a plan. But employee number one or owner number one says the most I can commit to is $100,000 a year into this cash balance plan. And the other individual says, you know what, I'm not concerned about this. I know I will always have $150,000 disposable income that I can contribute to this plan. So let's talk about how we can get to $157,000. The first one says that we're going to do $100,000 as a cash balance contribution or a defined benefit. The other one says they're going to do $150,000. So when I back into getting to the $157,000, I'm going to do a profit sharing contribution of $37,500, 401k deferrals of $19,500. You add them up, and I get to my $157,000. The other individual said they were going to do $150,000 as a cash balance or defined benefit contribution. So that only leaves $7,000 left to contribute. So I'm going to only make a $7,000 profit sharing contribution and no deferrals. And that gets me to the $157,000.
So this would be, when would somebody want to use something like this? If they knew that they wanted to contribute a fairly high amount?
Exactly. When they know they want to make a higher contribution than that $57,000. And in doing so, they want to have tremendous amounts of flexibility because they don't want to commit to doing $157,000 every year.
Right. So basically, they have this person they might be committing to. They're committing to at least 100 here. They can, that 57 is optional.
Correct. So on the first one, you're right. They're contributing to a minimum of 100. And the second individual, the minimum is 150 because that's what they've committed to on the cash balance.
What if you wanted to do it just as like 10,000 that you have to commit to every year, and then the other stuff, you know, you can add it in if you want? If
that's all you want to commit to, I would probably suggest you stay with just the profit sharing 401k plan because it's just not worth the cost or the stress of having that cash balance defined benefit plan and worrying about the rate of return. I would just, the only time I would add the defined benefit plan is if you were going to do 75,000 or more.
Okay, great. So that gives people a good kind of way to think about this.
Exactly. You know what? So let's just take a quick look, go right back real quick. Look at the difference on, so we talked about the minimum. The maximum that either of these individuals can do would be the $157,000 for the first individual because they've done the maximum profit sharing and deferral. And then the second individual, they can bring it up to the $57,000 versus just the $70,000. I'm sorry, just the $7,000. So they can do basically $207,000. So that's where you get your range, is from the 150 to the 207, or from the 100 to the 157,000. What is it?
Deferred plan is deferral. You can't make aggressive investments.
On the deferrals, you can absolutely make aggressive investments as an individual if you want to. It's just the cash balance plan that we really want to be conservative and just try to achieve that 5% return on the investment.
Right. So basically, it's the defined benefit plan, which here she has listed as cash balance that you need to be very conservative in because you don't want it to drop.
Correct.
Looking at the profit, like the 401k that holds the profit sharing and deferral money, that money you can make more aggressive investments with.
Correct. Okay.
Okay.
So really what I want to stress on this next slide is we're going to get the flexibility, and that's kind of what we're talking about here, is the defined benefit plan. First off, we need to make sure that everybody understands in the defined benefit plan, that is a trustee directed investment. So let's assume we have, more than 2 highly compensated or more than 2 owners. Those individuals don't get to say these investments are mine in the defined benefit plan, these are yours. It's everybody's assets go up, everybody's assets go down. It's the same pool of funds. We also, because of the liability, highly recommend that you consider funding this monthly or quarterly. Don't just do it as one deposit at the end of the year, because you want to get some of that dollar cost averaging, as well as you want to make sure that especially in, when we're in situations like this, that the company is still solvent enough that they can make funding of those contributions. For the profit sharing and the deferral contributions, each individual gets to choose their own risk level because these are participant directed, or usually are participant directed. So a lot of times when we're talking to owners about this, we tell them you need to consider this an overall portfolio and consider the defined benefit part, the more conservative part of your portfolio, and then use the profit sharing and the 401k investments to be the more aggressive part of your portfolio. Next slide.
All right, we are gonna have to wrap this up pretty quickly.
Okay, great. We're just on the last couple of slides. We talked about that pension benefit guarantee corporation. So know that there are premiums and there is protection that's required out there. On the defined benefit plan, there are those minimum, the maximum deductible amount there where it was 25% of covered pay on the defined contribution plan. If it's a straight cash balance or defined benefit plan, it's just the minimum required contribution. That's the deduction limit and the next component. In the event that you have a combined plan and it's non-PBGC covered, then it's going to be 25% or 6%. So it's 25% of the total contributions, or you can say the minimum required plus 6% of the defined contribution covered can go into the covered compensation.
Great, thank you. I have another question here that somebody's written in.
Okay.
And it says, what retirement accounts for a small business owner should I open up after maximizing a Roth IRA? I've heard a SEP IRA or a solo 401k could be great for maximizing contributions.
Probably, I mean, what you have to remember is that once an employer contribution is made, depending on your adjusted gross income, that will limit the amount of an IRA contribution that you can make. So typically what happens is the retirement plan contributions are made, and then it's determined if you can make a Roth contribution. Now, I guess with regard to the Roth though, because that's post-tax, that's based on your adjusted gross income. So that's the limiting factor there, where a deductible IRA is limited by your compensation and if you're getting an employer contribution or a 401k deferral. Correct, Claudia?
Yeah, and I think the other point to that question is maybe that it's maybe not so much about the Roth than it is, okay, I'm a solopreneur and now I want to maximize other deductions. And then it really comes down to, do you have employees? Are you intending to hire employees? How much, you know, from a cash flow and budget for the business and personal, how much can you actually put towards the plan? And then we would come back and say, well, if it's X amount, maybe a SEP IRA, you have no intention of hiring anyone, meaning you can max out the SEP and you don't have to be worried about having to make that same 25% contribution to an employee. Or you're at the point where you say, well, maybe I do need a 401k and I want to do some profit sharing. But sometimes the simpler plans, such as a SEP or individual 401k, do not require adding someone like Marilyn, and I work with Marilyn closely with clients that have these larger plan needs. But keeping the administration simple, you would go to like a SEP IRA or a solo 401k for sure.
Correct.
But it depends. So without knowing your situation, that's always a tough one for us to say, yeah, choose this or that, right? So it's, if in doubt, just always lean on a team of professionals.
Okay, so then another question is, what is Marilyn's thoughts on investing in real estate versus putting that money into your retirement accounts? Is there a certain threshold she'd say you should put into your retirement accounts before putting it into another asset class like real estate? That's a good question. I mean, I think that's one of the things we're actually looking at in this group, is looking at some of these questions, right? So this person is 25 and they want to retire early. So what you're talking about here, John, is something not necessarily someone like Marilyn would necessarily look at. This is more, this is a larger scale of kind of financial planning. Like how many of your assets need, if you put money into a 401k or you put money into an IRA, you can't touch that money. You can't touch money from those investments until after you're 59 and a half. So if you plan to retire at 40 or 35, then what percentage of your, you need to have enough investments that are outside of that retirement account bucket in order to live off of until you hit 60, when you can start taking from the retirement account bucket. So that those type of calculations are ones that we will go through, that we're going to be looking at. And also that's the kind of stuff that Claudia's software can help with as well. So
let me add just a couple of comments to investing in that, because we do run into this. First off, you know, from an employer's perspective, let's assume that you have accumulated enough money in your account and now you have enough money to invest in this real estate or a limited partnership, whatever it may be. If you allow one individual to do that, you have to allow everybody in the plan to do that. And that can open up some fiduciary liability risk, especially with an employee investing in that doesn't really know what they're doing. So that would be one of my concerns. Another one of my concerns with that is, let's assume that something happens with the company and we're going to terminate this plan. It can be very difficult to find an IRA custodian to take over that real estate. Now there are some, but it can be difficult or it can be expensive. So what happens is we terminate the plan, but in order to continue the tax savings on it, we have to put it in an IRA. So that's a consideration. Otherwise, you know, let's assume that we're now 72 and we have to start taking minimum distributions. Well, I have to look at that investment, and if that's a large part of my portfolio, is there enough liquidity to every year make those minimum distributions? So like I said, it's absolutely possible, but there's things that need to be discussed before you do that are long-term effects.
Yes, and Yeah, so we're definitely going to have a discussion on self-directed 401ks and IRAs. That's a very specific type of thing. There are specific custodians that handle that. And I can tell you some of the ones that exist out there if that's what you're doing. So we will have a discussion about that because that's a very, like she said, there's a lot of companies, a lot of accounts that won't let you invest in things like real estate. They just want you to keep it in stocks and funds and ETFs and so on. So we will definitely have a discussion about that for some of you entrepreneurs that like to have a little more control over your assets and get a little more creative. So we'll do another call on that for sure. Does anybody else have another question? We're going to have to wrap it up here quickly. But really, really appreciate Marilyn coming on and talking about this, and Claudia as well. So if you guys want to give her a shout out, but let me give you one more chance to ask a question. I don't see anything coming through on my chat. So I think I've asked the questions I was sent. All right. So I don't see anything right now. So I think we're good. Okay. Well, I am going to stop the recording, and everybody, let's give a nice shout out to Marilyn and to Claudia for coming on here to help us out. Thank you.
Thank you for the opportunity.
Thank you.